Hey everyone, it's Jay from DBA in a Box again, back with another of our episodes of Business Basics. Before I start, I want to remind you, hit the like, hit the subscribe, and ring the notification bell to get more of these videos if you like what you see. Today, I want to talk to you about some basic financial terms. I want to show you some of the basic financial concepts that you need to understand if you want to be successful, and they're going to set up some other things that we're going to talk to in further videos down the road, where I want to be able to use these terms and have everybody have a common understanding of what they are. Okay, so we're going to be talking about all those interesting financial terms. Profit, gross profit, net profit, cost of goods sold, acquisition costs, the concept of margins and gross margin versus net margin. And we're also going to talk about these and not just explain the term, but also tell you why it's important to you as a small business owner. So the first topic we're going to talk about is profit. And I'm going to use specific examples for these things. So profit. We all have the concept of what profit is. Profit is how much money you're making. Well, in order to understand profit, we have to understand revenue, also called sales. So what is revenue? What is sales? Revenue and sales is the amount of money that you bring in without regard to any costs associated. So revenue or sales, it's referred to both ways. Accounting tends to call it sales, and business and venture capital and those kinds of people talk about revenue. It's really the same thing. It's how much money you bring in a given period. So typically you're talking about either monthly, quarterly, semi-annual, or annual revenue. For example, if I was to say I have revenue of $12,000 a year, what that means is that every month I'm doing $1,000 in sales without counting the costs or anything. So this revenue and sales is the total dollars that your company brings in from all of its sources. And you can have multiple revenue sources. For example, you can have eBay as a revenue source. You can have Amazon as a revenue source. You can have Poshmark as a revenue source. You can have YouTube as a revenue source. You can have ad campaigns as a revenue source. You can have your storefront, your brick and mortar storefront could be a revenue source if you have one of those. In general, you want to have at least 5 revenue streams. And a revenue stream or a revenue source is nothing more than a way that you make money. So we'll go into revenue streams and what the different ones are and the possibilities and how you can make use of those. But right now, all we care about is that revenue or sales is the total dollars from all sources over a period. Okay? Or over a period or product line. You measure revenue as an aggregate. You don't measure revenue on a single item. You don't say, I made $275 in revenue selling that cell phone. That's not revenue. That's a sale. That's a single item sale. Revenue and sales in the context of financials is over a period or over a product line. So you can say that the Microsoft Xbox made $4.6 billion in revenue over its life. Or you can say, I made $50,000 revenue this year. Okay, so revenue, total dollars from all sources over a period or a product line. Next, and of course you can break that down. So if you have, you can say this is my annual revenue, this is my semi-annual, this is my quarterly, this is my monthly revenue. The main thing is it's the total dollars from all sources over a period or a product line. The next thing that we want to talk about is acquisition cost. what is acquisition cost? Acquisition cost is all of those costs that are associated with getting the product, getting it to you, and getting it ready to sell. So acquisition cost includes shipping from your source. Not the shipping to the customer, the shipping from the source. It includes the actual cost of the product. So if I buy a lot for $100 and I have $100 in shipping, that's $200 acquisition cost. Now if I need to do anything beyond that to get it ready, and by the way, these are hard costs. They're also called direct costs, meaning that they are directly related to the product. They do not include things like labor, and we'll talk about those. So acquisition cost is what you paid to get the product, get it to you, and get it ready to sell. For example, we have a lot of apparel that we put up earlier today. That apparel lot had an acquisition cost of the product, which was $100 or $201. It had the shipping, which was about $150. It also had cleaning and repair costs that had to be done to get the product ready to sell. So we'll call that make ready. That's a pretty common term. So that's all acquisition cost. So revenue is total dollars. Acquisition cost is what you paid to get it to you and to get it ready to sell, not counting labor. Cost of goods sold. Why is this different than acquisition cost? Well, the cost of goods sold includes other things that happened along the way. This includes shipping to the customer. Make it a little easier. Shipping to the customer. It includes packaging. Any costs that you have. For example, we didn't want to go dumpster diving for cardboard boxes, so we actually bought new boxes. And the cost of those boxes, and the cost of the packing tape, the cost of the labels for shipping, all of that is part of cost of goods sold, as well as your acquisition cost. It is all direct costs, not including labor or taxes. And we'll talk about this when we go all the way into profit. Cost of goods sold is all of the direct costs that you incurred as part of doing business, as part of the sale. So the cost of the product, the cost of shipping it to you, the cost of getting it ready, the cost of shipping it to the customer. It could include, so it does not include marketing unless you are, so the only time it includes marketing is when marketing is fee-based. For example, on eBay, you can promote a product and they take an extra few dollars off of the cost out of the product when you sell it. So that's a marketing fee. So that's all fees. If you're shipping internationally and you have to do something special to do so, that goes into your cost of goods sold. This is, by definition, this is the total cost of what you sold. Very important to know that. And finally, that brings us to profit. Okay, so what is profit? So there's several different defined profits that we need, profit measures that we need to understand. So the first measure is gross profit, also called GP. Okay, gross profit is very simply revenue minus cost of goods sold gives you gross profit. Cost of goods sold, also often referred to as direct costs. This gives you something called gross profit dollars. And then you take there's something called gross profit percent, and that is revenue minus cost of goods sold divided by revenue. And that will tell you your gross profit percentage. So let's talk about profit for a second. In general, we don't talk about gross profit on a single sale. We don't do that. The reason we don't do that is that it can be rather misleading. So for example, let me give you a great example of why we don't do that. So I bought a lot, and it was on video a couple weeks ago. It was electronics. It was $350 shipped. So this was my acquisition cost. My total cost of goods sold on that was about $120. Okay, so my acquisition cost was $350. I had fulfillment costs of $120. That was my shipping and my fees and everything else. And that gave me a grand total of $470 cost of goods sold. There were, and just to make the numbers really easy, let's say that there were, let's say there were 100 items, and I think it was pretty close to that. I think it was 199. But let's say there were 100 items, right? So when you're thinking about what your cost per item was, we have 470 cost of goods sold divided by 100 is $4.70 was our cost per item, right? $4.70. Well, in this lot, there were 2 cell phones, 2 new cell phones, by the way, and 98 light strings. These are little strings of light that they use to pad the numbers counts on pallets so that it looks like you're paying less than you are. Well, here's the reality. None of this is sellable. Those 2 cell phones sell for $189.99. So they sell for $190 each. That's it's actually $379, but let's just call it $380. Well, if my cost of goods sold is $470 and I actually sold them for $380 and I can get nothing out of these light strings, then guess what? I lost $90 on that lot. Okay? So my gross profit on that lot is the $380 that I earned minus the $470, okay, and those together equal minus 90, and if you're doing accounting, that would be 90 with brackets around it. Revenue was 380 minus 90 divided by, so first of all, our gross profit dollars on this lot was minus 90. And our gross profit percentage was roughly 40%. And it's like 42 or 43 or something like that. But it was roughly negative 40%. Okay, so, but if my cost per item is $4.70 and I sold it for $189, you would think that I made $185 on that. But the fact is that once you figure everything in, I actually lost money. Okay, now those aren't real numbers. We didn't actually lose money. That was just for the sake of example. Although I will say that we do on occasion lose money, and sometimes we do it deliberately. And we do it deliberately in order to achieve other objectives. So for example, as a new seller on eBay, we need to establish credibility. So we're willing to sell small items at a loss of 10 cents, 20 cents below what it costs to in terms of total cost of goods sold. We'll sell at a loss in order to get the good review. And that's purely to establish credibility. It has nothing to do with a strategy of losing money. In the future, we are going to talk about something I'm going to define here in a minute, which is called cash flow. And we're going to talk about why cash flow is more important than profit at length in another couple of videos. So anyhow, gross profit. Okay, so then there's something called net profit. And net profit is your gross profit minus, let's leave that there, minus gross profit dollars, minus something called overhead contribution. That's the cost of running your business. Divided out among all of your sales throughout the month. And it's usually done as a percentage of the sale, so a certain percentage of every sale goes to running your business. It goes towards salary. If I've got an employee, I'm paying $900 a month. That means I'm paying them $30 a day. If my sales were $9,000, then my overhead contribution would be 10%. Okay, obviously not a good ratio. The lower that number is, the better. But overhead contribution has to be counted in here as part of your net profit. Your net profit also includes, or your overhead contribution also includes things like your annual fees, business licensing, any insurance that you buy. It includes all of those things that are not directly attributable to a product sale, and then it's split evenly across all of your sales. So overhead contribution, the higher your overhead is, the higher your contribution is. You want to keep that number really low if you can. You also have taxes. If your business is paying taxes, those taxes have to be counted into the net profit. There's things like if you have a retail location, you have location costs. You can have storage costs. You can have utility costs. All of these things get deducted from your gross profit to get to your net profit. Your net profit is what is often called the bottom line. It's how much you actually made in profit in your company. And I will suggest to you that it is not always important for that number to be super huge. This is an important number because it needs to be a positive number. If your net profit's a negative number, you're struggling. That said, there are other topics that are just as important. There's in between gross profit and net profit, and I'm not going to get too far into it. There's something called EBIT. EBIT, that is I'm going to put this on the screen, earnings before interest and taxes. Then there's EBITDA, earnings before interest, taxes, deductions, and assessments. Is something called cash flow. Cash flow, they say cash flow is king. Okay, what is cash flow? It's very simple. It's over a period of time. What is, and typically these are shorter periods of time. They're like, most typically it's over a 1 month period, or month by month, meaning we're measuring it every month. You have cash in, you have cash in minus cash out. Okay? And it doesn't matter if this is cash or if this is credit. This is how much money came in minus how much money went out. And so typically the way that this looks when you look at it over time is, if this is January, February, March, April, May, and so on, right? 1,000, 2,000, 3,000, 4,000, 5,000. This is dollars on this side of the graph. So typically, let's say that this is 0. This is 0. Minus 1,000, 1,000, 2,000, etc. Okay? So 0 is this line, minus is below it, positive is above it. Okay, so if we started our business in January, typically what happens is in the very early stages of your business, you're putting out money to get ready to sell. You're buying inventory, you're buying shipping supplies, you're spending time and maybe money on preparing your marketing efforts. You're doing things that are not generating revenue. They're non-revenue generating activities, but they are essential to be able to get your business off the ground. So for example, for me, my strategy involves getting a lot of inventory, playing the numbers game. We'll talk about that and why I'm going that route with it. And all of those things have a cost to them. And in fact, right as of today, 1 month into this, I am at negative $2,100, okay? Now we have had some sales, but we're at negative $2,100 is our where we are right now. So the way that actually looks is on day 0, we went negative $2,500. Remember, that was what I was investing in the business. We went negative $2,500 in the first month. In the second month, and I'm just using January, February, March to put it on an even year. We'll talk about fiscal years at some other point. But effectively, we started our business, and in the first month, we were minus $2,500. The next month, we were plus $1,400 and minus about $1,020. So we were actually positive cash flow, which is really surprising at this point in the game. We were positive 380. So we came up to here. Okay. Oops. Second month. So we came up to here. Now the way that this looks like over time for most businesses, and let's just take the numbers off of this and say that that's dollars on that side. We're not going to nail it to a dollar because we're looking at what it looks like over time. Typically, the way that this looks is that there's a period of time where you're down, you start to make sales, you climb, you start to plateau, okay, and then somewhere down the line, you take off. And they call this the hockey stick, okay, that's called the hockey stick. So we're talking about cash in, cash out. So negative, 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 negative. Then you turn positive. So this is called negative cash flow. and this where you cross the line, now you are positive cash flow. Okay, really important metric, because this is going to drive things like getting loans from a bank or getting credit, a line of credit. This is going to affect that line of credit. It's going to affect the interest rates. The biggest factor in finance is cash flow. In fact, it is much more important to have positive cash flow than it is to be making a profit. Let me give you a perfect example of that. And this is a really great example of this. So I'm pretty sure everybody here has heard of Uber. And Uber just went public. Now, we think of Uber as a multi-billion-dollar company, and they are certainly valued that way. I think they were valued, if they weren't valued at $1 trillion, they were valued pretty damn close to it. That may not be accurate. I'd have to look up what their actual valuation was. And we'll talk about valuations at some point where we talk about venture capital and angel investment and all those kinds of topics. But, so Uber, big major company. CEO makes a ton of money. The people working at the company make a ton of money. The people driving, not so much, but they still make money. At the end of the day, though, Uber loses 58 cents per trip. Every time you get into an Uber, you can call Uber, they come pick you up, they take you somewhere, drop you off, you pay. Uber loses 58 cents. They're not profitable. Okay? Now let's think about that. This is one of the biggest shining star companies in the world, but they have negative cash flow. Every single ride they do, they lose 58 cents. Now they have some other areas where they make some of that back up, but this was actually publicly disclosed in their SEC filings that they lose 58 cents every time somebody gets into an Uber. But yet, they were able to raise millions in funding from venture capital companies and from, round A, round B. First, second round of capital. Why would investors invest in a company that had no or negative profits? Well, it's because if you looked at their cash flow was positive. Why was it positive? It's actually kind of a Ponzi scheme kind of thing. It's not truly a Ponzi scheme. I'm not calling Uber a Ponzi scheme. Let me tell you why I say that. It's because their past expenses are being paid, or their past revenue is being paid for with future losses. So on paper, when we go back to our graph, they look like this, just like we described, and they're in here. That's why they went public, because they had the opportunity to do an IPO, to bring in more financing from here to pay for that. And the hopes that they have, and this is kind of an interesting case because the hopes that Uber has is they've been amassing a great deal of data on everybody that uses Uber, where they picked them up, where they dropped them off, what time of day they picked them up, what time of day they dropped them off. They can tell with pretty good certainty whether you were out clubbing last night or not, based on the Uber trip that you took to go home from the bar. Or they can tell that you order food in because they've got Uber Eats, right? So Uber delivers to your house, and that Uber trip, they know what kind of food you like. And they can take all of this information that they have, they can aggregate it, because they don't want to actually tell people, hey, Jay does this. What they will say is that this group of people that includes Jay tends to do this. And it's really interesting how companies make money on data. Being a data person myself, I kind of sort of work in that industry, so it's really interesting to me. Probably boring as heck to you. Just know that when you talk about loyalty cards, when you talk about Uber, when you talk about eBay, Google for sure, all of these companies are tracking the information about you in order to be able to more effectively sell to you. That's what Ad Choices is all about from Google. It's about being able to deliver content that's relevant to you. So, and because they can do that, they can charge more money for those ads. So anyhow, so Uber, not profitable. In each individual ride is a loss. On the average, over their lifetime, they average, or over, actually not over lifetime, but over the last 12 months, they averaged 58-cent loss on every ride. They are not profitable. However, they have a very positive cash flow, and they're getting injections of venture capital, which helps them to pay for this. Which helps them to pay for this loss and keep their company moving to grow their cash flow. So over the long term, is it sustainable to have a negative amount? Only if you have other sources of capital coming in. And in our case, for Liquidation Pals, that other source of capital is your bank account. So you really want to get a handle on your cash flow and your profitability until you have somebody that says, I want to give you so much money that you don't have to worry about that anymore. Not going to happen for 99% of us. There's a reason they call it the 1%, right? So anyhow, so that's cash flow. Very important, and we will go way into depth on cash flow. But basically, the idea is you invest your money in the beginning. If you're bootstrapping, which is what this is called, we'll talk about venture capital angels and bootstrapping versus funding, and sources of funding. We'll talk about sources of funding. So typically, for what we're doing, this is called bootstrapping. It's the money that you spend to go to the thrift store. And you may be able to hold it close to zero because you're not investing in the business. You're investing in individual products which you're then selling. In order to move above a low cash flow threshold, in order to move past that, you have to invest in more inventory, bring it in, and sell it. And so anyhow, so the things that we talked about. This is a primer. Those are the basic things that you need to know. To begin with, we really needed to define those terms. So let's talk about let's just really quick recap the terms, and then we'll move on. And next week we'll do another one of these that we'll dig more in depth, but and start making use of these terms. So the terms that we talked about. Sorry, this thing is kind of old, so the stuff sticks in it and makes it look dirty. So the things that we talked about profit. That's how much you're making. We talked about gross profit. We talked about gross profit dollars. We talked about gross profit percent. We talked about net profit dollars. We talked about net profit percent. We talked about margins, and we talked about cash flow. So once again, just a quick rundown. Profit, how much you make. Gross profit is how much you make with it is revenue minus acquisition cost. Net profit, it's also called revenue minus direct costs. Net profit is revenue minus all costs, and then divided by revenue to get percentages for both of those. Margin is the selling price divided by the cost, expressed as a percentage. And then cash flow is how fast money is moving in and out of your business. So in the cycle, you spend on whatever, then you sell whatever, and then you spend it again. So this circle is your cash flow. I buy something for $10, I sell it for 20, I reinvest the 20 and I sell it for 40, I reinvest the 40, I sell it for 80, etc. And so how cash flow is a measure of the velocity or the traction that your business has. So cash flow, and this is by far the most important measure in a business. The only time that cash flow is not as important is when you are in an inventory glut. So for example, I've been buying all this inventory. The next 3 months, I'm going to be selling all that inventory. So I'm buying inventory for 3 months, I'm selling that inventory for 3 months, and I'll be using, and as I sell that inventory, I'll be buying replacements to backfill my inventory and keep my inventory at a high level. So my first month, my cash flow is very negative. My second month, it'll be slightly negative. My third month, it'll be most likely negative. My fourth month, I expect to be positive or break even. And then in month 5, I expect to go positive. That's what I think cash flow looks like for me and will look like for most of the people in this business. You need to know every single one of these numbers. If you own the business, you need to know every single one of these numbers by heart. You need to be able to spout them. You need to be able to say, my gross profit for the last quarter was X. My gross profit percent for that last quarter was X. My margins, my average, remember we talked about average margin? Average margin for that quarter was Z. My cash flow, I'm net positive and I make this much more than I spend every month. I'm net negative. So again, cash flow comes in the gross and net, but we almost inevitably talk about net cash flow. So net cash flow is what you want to measure there. Gross cash flow doesn't mean a thing. So net cash flow is what you really want to know. That's, how much in total did I spend, and that's all your debits. So if you're looking at your checking account, in a checking account statement, you have total debits and then you have total credits. Net cash flow is total credits minus total debits. So if you're on a budget and you're managing your money properly, you should be positive cash flow on a personal level. And if you're, unless you're investing into a business like as a startup, is the only time that it's okay to be negative personal cash flow. If you are not managing your money and you're spending it all and you actually have more going out than you have coming in, that means that you are making use of credit to keep yourself alive, or you're getting infusions of cash from another source. Remember I said that? Maybe mom and dad are giving you some money to help you stay alive. Those are really important concepts and they're all around cash flow. Now next week we're going to talk about credit and appropriate uses of credit. And these terms are going to come up when we talk about how to get credit and financing. And then we're going to talk about appropriate use of credit. So stay tuned for that next week. In the meantime, hit like, hit subscribe, ring the notification bell, and I will see you next week.